Hello everybody, welcome to another episode of Erickson TV, courtesy of Lauren. Hello Lauren.
Hey everybody.
Hey Lauren, as part of our New Year's gift, we received a new tax law change
Finally.
right at the last minute there. In fact, I remember I was reviewing the Senate. I think they were up to like 3 in the morning putting the final details together. Then the House voted on New Year's Day the next day. It's called the 2012 American Taxpayer Relief Act. And we don't have time in this video to go through every multiple tax law change, but I thought we would just give a broad overview. As part of this video, though, we are going to send out, whether it's part as this email or a separate email, we're going to send out an attachment of full details of the law. Okay. But the thing I do like about the law is it does provide some certainty. Many of the changes are not just saying, for 2013 only. It's saying permanently, which I think that, and you can see in retrospect this past week, the stock market is like that because they like certainty.
Right.
But I think when people look at it from first glance, they're going to say, well, this doesn't really apply to me because a lot of these changes occur for people that are like making $400,000 or greater of income.
Right.
And realistically, that's most of our clients. That's not them.
Right.
There are a few clients that make that much, but most clients make below that. But when I look into the details, there are some changes that we should probably address that are going to make a difference in 2013. The biggest one, and I think this is one that people got used to for the last couple of years, is they had this temporary payroll tax cut.
Right.
And basically it was a 2% reduction. And it was called temporary, so it wasn't, I don't think anybody was expecting it to be permanent, but they took this away permanently in this new tax law. So somebody making about $50,000 a year, that's going to be a difference in the paycheck next year that they're going to be paying $1,000 more in payroll tax.
Right.
To make a $100,000 paycheck, it'll be about $2,000. So that one doesn't have anything to do with how much money you make. It's whatever you're earning as wages. You're gonna be back to the normal payroll amount. Now, from a long-term perspective, I don't think that's a bad thing for knowing how poor shape our Social Security system is.
But people will feel that.
People will feel that.
Yeah.
All right.
They're going to notice that one.
The one thing, the other thing I want to talk about is the estate tax exemption. That became permanent, $5 million per person.
Oh, really?
Yes.
We didn't think that was going to happen.
Yeah, I didn't think that was going to happen. So up through the end of last year, the maximum estate tax at the federal level was 35%. So as part of this compromise, they said, okay, we're going to permanently say it's going to be $5 million. It's actually $5,120,000 plus inflation. It goes up every year, the exemption. But we're also going to raise the rate to a maximum of 40%. But that being said, for most of our clients, with some basic estate planning, you can make sure that you and your heirs will never have to worry about paying the estate tax, which I think is a good thing.
Yeah.
Okay. Last but not least, for our investors, for the people that make less than the $400,000 approximately, they still have the lower capital gain rates for long-term capital gains and for qualified dividends, which is a good thing.
Interesting.
However, there is for people that make $200,000 or greater, part of the Obama healthcare law, which has nothing to do with this, there is a surtax on investment income for people that make more than $200,000. So again, at first glance, this looks really good, but there is still the possibility for many people here in the Seattle area, for instance, that could be paying a surtax on their dividends and interest. So, and then for our small business clients, I think there's one great thing that they made permanent, which is that for businesses that buy lots of equipment, going with the original tax law expiring, they were going to be limited to writing off $25,000 of equipment purchases as a 179 deduction. Now that's been raised to $500,000, back to $500,000 again.
Good.
And they also put in a thing called bonus depreciation, which allows you to write out 50%. And the thing about bonus depreciation, and this is really great for, let's say, somebody that's employed and then they just want to start a business. Usually the first year of a business, what happens?
You lose money.
Yeah, you lose money. Well, a little known fact is that, so let's say somebody worked half the year and made $50,000 of salary.
Okay.
And then let's say they had a business and made a loss the second half of the year. Well, that 179 deduction with equipment would not work for them because you have to have profit in the business.
Right.
However, the bonus depreciation allows you to deduct 50% of your new assets that you buy for your business, regardless if you have profit or not, and you can take that loss then and apply it against your wages you earned earlier in the year. So I kind of like that there's some things for small businesses that allow you to accelerate tax write-offs. Many of the education credits, the child credits, that became permanent.
Oh, okay.
Okay, so we're good to go there. So I know we just gave you lots of detail about this new law. Please feel free to contact myself or Lauren. We'd be happy to see how it applies to you. I'm already doing planning for some of our clients that are interested about it. But we are going to send you a very detailed list in a summary format about how this may apply to your specific situation. Any comments to finish up this episode?
I'm glad they finally passed it.
Yes, I like certainty because how many videos did we do last year about this system? So thank you very much for watching Erickson TV. We'll see you next time.
See you
Bye
next
now.
time.